sharp rally in stocks on Friday as the latest payrolls numbers came out. We'll be talking about what these numbers mean for the broader economy with our next guest, Danielle DiMartino Booth. She is the CEO of QI Research. Welcome back to the show, Danielle. Always good to see you.
Good to see you, David, on this non-farm payroll Friday. Indeed.
Yeah, 150,000 jobs added, 20,000 fewer than expected. The market is interpreting this as very good news, apparently. The S&P and NASDAQ both up more than 1% as of noon Eastern time. Why?
Well, the why is that we've had a 4 sigma event in the yield of the benchmark 10-year treasury. And so, it veering, down towards 4.5% when it was just a matter of days ago that we were discussing the world as we know it ending. If it was north of 5%, it's a huge move that we've seen in a very short space of time. So right now the markets they're off to the races, celebrating the fact that Jay Powell is no longer going to be throwing his wrecking ball around and he's not going to be raising rates anymore.
Are we entering an era where bad news is always going to be good news from now on? Because if we consider that if we have further deterioration in the labor market, at some point the market has to realize, okay, there are bigger problems than the Fed.
Yeah, I think David, I think we're actually crossing that Rubicon right now. We're celebrating lower bond yields and, maybe the idea that, maybe somebody can refinance or I don't think lending standards are going to get looser anytime soon just because the Fed's stopped raising interest rates. And more to the point, right now we're celebrating yields, but at the end of the day, there's an academic economist. I don't really agree with most of the body of work she's conducted, but the market certainly follows what they call the SAM rule, Claudia Sahm, SAHM. And what her work has shown in the past is that in every U.S. economic cycle, once the unemployment rate is half a percentage point off of its lows, then we're technically in recession. So in other words, it's in the rearview mirror. And that's exactly what we saw with the unemployment rate hitting 3.9%. It's a half a percentage point above the current cycle low of 3.4%. We're technically in recession. And what that means is that we will be able to celebrate the earnings season that we're going through right now and the beats that we've had. But going forward, there's something that you cannot dispute, David, and that is revenues. So when you're in risk, you can have your accountants, play all they want with your earnings report and massage them and one-time expenses, and all of a sudden they blew it out. Oh my God, how did they beat their bottom line? You cannot fudge revenues. And when the market sees that revenues are starting to decline, all of a sudden bad news is bad news.
You said you disagree with the SAM rule. Is that what you said?
I say I disagree with a lot of the analysis that she's done. I think the bar is set too high. My mentor at the Dallas Federal Reserve always told me that once you had a 0.3 of a percentage point rise off of the low that you were already in recession, hers is a higher bar. So be it. Now we've also crossed that higher bar.
The market rally that we saw today isn't just exclusive today. It started really earlier the week when the Fed announced that they did not raise interest rates or kept rates unchanged. Furthermore, I believe Jay Powell signaled that the committee is not interested in looking at further rate hikes at this point, is I believe his words. Why is it that moved the markets in that way? Because presumably, if you keep rates elevated, shouldn't that be bad for the markets?
So I think what markets were really celebrating was this impression that, Jay Powell was like in a medically induced coma. He read most of his answers when he was at the podium. He was scripted completely, and he didn't say anything. He never went off script and went all bearish. He basically said, we're going to follow the data. There's a lot between now and then. We're not committed to any particular path going forward. But there wasn't this kind of body language, I can be easily angered, just you watch, I'll be raising interest rates type of Jay Powell. There wasn't, Dirty Harry was not at the podium. It was more like Mr. Rogers. And so I think that's why investors were as heartened as they were, because there was no threatening bad guy Jay Powell. He was just wah, 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 wah. We do not have any plans to raise or not raise interest rates. It's all going to depend on the data. But by then, the ISM manufacturing report had disappointed to the downside, and we saw one negative economic report after another that is kind of putting the nail in the coffin of Jay Powell. So Dirty Harry ain't coming back. That's what the market's celebrating.
Yeah, and I'm trying to visualize Jay Powell as Fred Rogers. So our neighbor Jay Powell, what is he thinking now? Is he eyeing unemployment ticking up, or is he still focused on inflation? Because presumably, if inflation stays sticky, but the unemployment rate continues to go up beyond 3.9%, he has to start making a choice or not.
He does, and this is when. I mean, I think he's got a little bit of a reprieve because politicians aren't the brightest. So they can still brag and say that the unemployment rate is south of 4%. It still sounds really good for it to say 3.anything%. Once we get the next move up, though, I think it's pretty much game over, especially because then we'll be T-minus less than a year before the elections, and they're going to start looking for the bad guy. And they're going to pin it on Jay Powell. Actually, I think you and I've spoken before about Truflation, TRU. Their data this morning actually shows that on a trailing 12-month basis, that the headline CPI is about 1.9%. So it looks like the Fed's even going to be able to. It looks like the Fed's even going to be able to hit its 2% inflation target, and we're starting to see more evidence thereof. We saw very weak earnings in the payroll report as well. So that big boogeyman of wage inflation is also going away. Jay Powell's job's gotten a little bit harder.
Are you surprised that as the economy is showing more signs of entering a recession, as you pointed out, that inflation is still sticky somewhat?
Well, I was somewhat heartened when the GDP report came out last week that the core PCE had dropped to 2.4%. So it's starting to go in the right direction. We just have to bear in mind, we had $757 billion of paycheck protection loans that were forgiven. And then we had a chaser on top of that of upwards of $300 billion in employee retention credit. So what we've seen right now, I think, is more the last hurrah of consumption as these stimulus checks continue to flow out at a much lower pace than they were before. But what we're looking at basically is an extra $1 trillion that was injected into the U.S. economy that's now being exhausted at the end of the current month, November. That's the very last forbearance for FHA mortgages will expire. So as of December the 1st, you've got the last vestiges of Americans who haven't made their mortgage payment since March of 2020. You have them coming back online as well in the student loans. But right now we're seeing a great confluence of factors that had supported consumer spending. But if you dig into University of Michigan, the individuals who have the bleakest outlook for the unemployment rate are the top tercile of income earners, the wealthiest. And they typically are also called boss. So if they think the unemployment rate is going to go up, they might be right.
Well, let's circle back to what we talked about 2 months ago. You were telling me about the research you just mentioned, which is the employee retention credits. First of all, let's recap how that works and how that affected consumer spending up until now.
So with the passage of the CARES Act, if you were able to demonstrate as a company that your company had been closed down forcibly by the government shutdowns, then there was a loophole written into the tax code that said that you could claw back up to $21,000 per employee of payroll taxes. Now, when Biden came into office and passed his first stimulus bill, he expanded the employee retention credit to say if your business had been interrupted in 2020 or in 2021, even if you formed a new company, you could claim the employee retention credit, then up to $26,000 per employee. So what was designed to be a program that cost the U.S. taxpayer $60-70 billion has barreled towards $400 billion because it has been really rife with fraud, all kinds of advertisements on television. The Wall Street Journal's done some good reporting on some of the larger players that have now stopped selling the employee retention credit. The IRS pulled the plug on September the 14th and said, it's clear that so many people are breaking the law with this that we're going to pull the plug on this. And in fact, the IRS said, no harm, no foul. If you want to send your employee retention credit proceeds back to the government, there won't be any criminal prosecution. So there's a window of opportunity to send Uncle Sam the money back. You and I, we pay taxes here. We welcome your checks, send them back. But the point is, we went from $29.8 billion in the month of July to 13 in August and 6 in September. So this massive source of direct cash directly deposited into Americans' checking accounts cash dwindled from 30 in July to 13 in August to 6 in September to about another 6 in October. So the spigot's been turned off.
And you think that translated to higher retail sales?
I think that translated to the higher retail sales that we saw in third quarter GDP, because you're taking that money that you receive in August and spending it in the fall. But ask any airline about their international bookings right now, and they have fallen off a cliff because the extra money is not coming. So people they're taking the vacations they planned, knowing they were going to get all this money from the government. But in terms of what's behind it, not quite, not anything in the way of tailwinds.
When does it end, this program?
Well, it's temporarily on hold. And right now the IRS is trying to permanently end it. So there's probably $150 billion in unpaid claims. But I think that they're going to trickle out into the economy rather than come out in a gushing flood the way that they had been when the ERC started to truly be abused in a big way. And the money really started flowing, which would be first half of this year.
Student loan payments resumed in October. They were on pause during the pandemic. I'm curious as to how that may affect spending. We'll see in the data. What are you expecting?
So right now, I'm not really expecting much. In theory, you're supposed to be paying your student loans back. In practice, if you don't have any intention of doing so, there's no penalty until October of 2024. That's the first time an unpaid student loan is going to be reported to a credit agency. So they've really pushed pause on that. So the people who don't have any intention of paying them back, they're still not paying them back, and they're not being, their credit's not being impaired as a result. The people who have begun to repay their student loans, they're in the crosshairs. And why is that? Because they make so much money that they don't qualify for some of these forgiveness plans. And unfortunately, David, they're also one and the same with a lot of kind of millennials who moved out of cities for the first time when COVID hit. So they've got a mortgage for the first time. And since they were outside the city, they also had to have a car for a first time. But at the same time, they didn't have to pay their mortgage. They didn't have to pay their car loan for 12 months. So they took on more credit card debt, but they make too much money to qualify for forgiveness. And it's this particular upper income cohort of spenders that I'm most worried about, because they account for a lot more spending in the U.S. economy.
Okay, well, Danielle, let's finish up on the on market and investment implications. So the biggest change in the markets, one of the biggest changes since we spoke, I think late July, was the continuing rise of the 10-year yield, the long end of the curve, as well as the rise in the DXY, I guess in response to that. Has your investment outlook or portfolio allocation changed because of the fact that the 10-year is now, or at one point last week, reached above 5%, which is the highest it's been in 17 years?
So, it's a complicated question. The long story short is I don't anticipate Jay Powell being forced to reduce interest rates anytime soon. So you don't have to go out to 10 years of treasury maturities. You can still get quite a nice coupon just by buying a treasury bill. And I think that that's going to be the case for some time, because I do think he is committed to higher for longer. So you can stay very short in your maturities, get a nice yield on your cash. And of course, we've started seeing gold fly, which it will. It will, even as inflation slows, of course, because going into recession, that's when your gold is even more valuable. And that's why I think we've seen gold really take a step up from here.
Gold typically doesn't perform well during a rising yield environment, especially when the yields move up this quickly. Was gold's move this month solely a reaction to, I guess, the tensions in Israel, or was it something else?
I think that geopolitics played a huge role, as well as, again, a growing body of evidence that the largest economy in the world is going to go into recession. The China reopening trade wasn't what we'd hoped for it to be, as certain a lot of investors had hoped for it to be going into 2023. It's apparent that Europe is now in recession. So once you get a global recession, global trade declining for a full year and that's what we're looking at in the trade figures. There are fewer and fewer places to hide. And I think that that's why, in addition to what's happening in Israel, you've seen gold tick up.
If you don't anticipate Jay Powell to cut rates anytime soon, are you then also anticipating the U.S. dollar to remain somewhat strong?
So I think that we certainly have seen quite a bit of dollar weakness as the 10-year benchmark treasury yield has come in, but for the reasons I just mentioned, right? China's not re-accelerating, and it looks like Europe is going into recession. So at moments like these, I pull out my old boss Richard Fisher's adage: the dollar is still the most attractive horse in the glue factory.
Sure. Okay. So given everything we've discussed so far, what are your asset allocation priorities right now?
Right now, I'm in the protection mode. I really am. You are not being compensated for taking on credit risk, period, end. We've not seen high yield credit spreads gap out to the extent that we should have, given where we are in the bankruptcy cycle. So, and now I would say the same thing. I think the stock market is definitely flying high on liquidity and Bitcoin being up and what have you. But again, as long as bad news is good, but we know for a fact that the bad news is going to continue to get worse, I don't think you're being compensated for taking on risk in the equity market or in the high yield bond market.
Even despite the downturn that we've seen, the risk reward profile is still not there for the equities markets. The downturn ever since July, yeah.
A week ago, we barely had crossed a 10% correction line, and then it's been off to the races ever since then. So no, I don't think that we've seen anything in the way of capitulation in the stock market. And that really is when you want to start nibbling. It's when people start to despise the asset class, and we're just not there.
Okay. What else can we learn from QI research? What are you working on these days?
So, we're working really hard at QI Research on what we were talking about before, kind of where's the recession, where's Waldo, and trying to help our investors understand the enormity of the fiscal stimulus, not the Inflation Reduction Act, which belongs in air quotes, not infrastructure spending, but actual cash to households. And we're watching that. We're also watching continuing jobless claims march up 6 weeks in a row, and how this is going to manifest, because it doesn't look like there's any future fiscal stimulus coming until after the election. We're talking about going into recession, but no fiscal relief until March of 2025. That's what we've got our eye on right now.
Perfect. And where can we follow your work, Danielle?
So come to DiMartinoBooth.substack.com. Love to have you as a QI Research client. And of course, follow me on Twitter at DiMartinoBooth.
Excellent. We'll put the links down in the description below, so make sure to check out those links and follow Danielle. Thank you very much for your time today. I understand you're traveling, so I appreciate your time.
Thank you, David. Take care.
Take care, and thank you for watching. Don't forget to like and subscribe.